You know, when you think of the world's biggest corporate body shop, you picture thousands of consultants billing endless hours. But instead of hiring more people, they just committed $9 billion to basically buy their way out of the traditional consulting model.
Yeah, because billing human hours just does not scale the way it used to. They are aggressively buying platforms and software now to replace the headcount.
Welcome to Earnings Unscripted. It is June 18th, 2026, and today we are unpacking Accenture, ticker ACN, and their Q3 results. And honestly, the market reaction is just a massive disconnect from the actual numbers they printed.
Oh, it is a bloodbath. I mean, the stock was already grinding down almost 9% over the quarter, but then earnings hit and it just fell off a cliff. Down 17.5% pre-market, it found a floor and closed the regular session around 127, but still a severe gap down.
Quick reminder before we figure out why Wall Street is panicking, nothing we say here is financial advice, just our own slightly caffeinated personal opinions.
Good to clarify. Please do not rebalance your portfolio based on my skepticism.
But look, the panic is wild because the surface numbers are really fantastic. I mean, revenue hit $18.72 billion. That's up almost 4% from Q2.
Right, and profitability was practically textbook. Operating margins expanded an incredible 320 basis points, up to 17%. EPS hit $3.80, jumping nearly a full dollar from last quarter.
Okay, so they are making way more money on higher margins. Why the massive pre-market cliff dive?
Because the engine of future growth is sputtering. Look at new bookings. They dropped over 12% sequentially, down to $19.32 billion. Clients are flinching. They're delaying the really big IT overhauls into the next fiscal year.
Right, and Julie Sweet actually quantified it on the call. She said the macroeconomic drag, specifically around the Middle East conflict, actually sliced $100 million off their realized revenue this quarter.
Exactly. Geopolitics is actively freezing enterprise spending across the broader EMA region. Corporate boards do not sign off on massive transformations when they're terrified of the news cycle.
Which is fascinating because the work they actually managed to close is straight out of a thriller. Like, they're not just helping clients migrate basic cloud software anymore. They're physically embedding sensory tripwires deep into remote electrical power substations to, shut down state-sponsored hackers before they can black out the grid.
Yes, and that's precisely why they're targeting that $9 billion for M&A this year. They want to dominate operational technology security. You can't just throw a junior business analyst at a power plant firewall. You have to own the proprietary tech.
They're totally rethinking their entire identity. All right, let's get into the details on how this capital shift is actually going to work without breaking the balance sheet.
Well, by taking on debt, actually. Angie Park stated flat out they expect to access the long-term debt market to optimize the capital structure. They are sitting on about $10 billion in cash right now with flat debt, but they need fresh liquidity to absorb this $9 billion M&A blitz.
Which is a staggering jump. Usually they deploy, around $3 billion for the year?
$3 billion year to date. Exactly. So they are tripling the run rate. But here is the crux of the whole report for me. The massive M&A push, it is not just about getting bigger. It is an escape hatch.
From the traditional billable hour?
Yes, from the FTE, the full-time equivalent model. Julie Sweet was remarkably blunt about this on the call. She basically admitted that changing client buying patterns in legacy services, it takes too long. So she said, quote, "It's much easier to go into new categories and switch to non-FTE models."
That is kind of wild. The CEO is openly acknowledging that training their Fortune 100 clients to buy subscriptions instead of, hundreds of consultants is too hard. So they're just going to buy companies that already operate that way.
Exactly, because trying to pivot a nearly 800,000 person workforce organically, it's like turning a super tanker with a paddle. You have to buy the speed. You acquire Dragos. You acquire NetRise. These are product-led operational technology plays. You are buying the margin expansion.
Right, you lock in software-like revenue. But there has to be a catch, because acquiring SaaS platforms at current valuations, especially cyber and AI, that generates heavy purchase price amortization up front. Does that not drag their bottom line before the real leverage even kicks in?
That is the exact risk. The initial margin blend is going to hurt, and it brings us right back to the top-line growth problem. The huge enterprise clients are freezing up due to the macro environment, right? Large discretionary managed services deals are sliding all the way to 2027. So to fill the revenue void while this massive M&A digests, they are launching a completely new lifeboat.
Accenture Edge.
Edge, yes.
They just announced it, explicitly targeting the mid-market. Companies pulling in $300 million to $3 billion in revenue, which feels like a huge departure because traditionally giant global consultancies bleed margin on smaller projects. The overhead just crushes them.
They do. A legacy firm usually cannot afford to get out of bed for a $50 million company. But Sweet Hot sized this mid-market at a $240 billion addressable TAM. And the only way they survive playing in that pool is if they are absolutely not deploying custom consulting.
They have to productize it, selling a pre-packaged IT ecosystem in a box.
Right, and we are already seeing them execute this philosophy. Look at what they just did for Bath & Body Works.
The retail fragrance brand?
Yeah. So they used agentic AI to completely gut the manual intervention in the retailer's back-end supply layers. They turned a bunch of chaotic human-heavy procedures into a streamlined managed service, just physically removing repetitive manual labor from the chain.
Okay, so Accenture is essentially selling the exact same medicine to clients that they desperately need to take internally, getting humans out of the operational bottleneck.
Precisely. You sell software and automated AI agents instead of a bus full of business analysts. But the timing of this transition is the real friction point. In the immediate near term, the big whale clients are still hesitating.
And we saw that in the guidance. Angie Park used some very cautious language around the fourth quarter. She specifically said, given the macro uncertainty, we expect more of the guided range to be in play.
Which is CFO translation for, we might hit the absolute floor of our own forecast. They are clearly seeing discretionary spending deteriorate down to the final weeks of the third quarter.
Which means the broader macro fears are still very much steering the ship here. All right, so let's take a step back. We've got a massive structural M&A pivot, a brand new lifeboat targeting the mid-market, and highly defensive guidance. What does this actually mean for the company's trajectory and the stock heading into the back half of the year?
It means they're actively paying a premium to outrun their own legacy model. If you look at the Q4 guidance, they are targeting roughly $17.75 to $18.4 billion. That is, well, it is a very soft 1 to 5% growth range.
Right. And honestly, even that feels fragile. I mean, Angie Park literally warned that more of the guided range is in play down at those lower ends.
Exactly. CFOs do not use that phrasing when demand is accelerating. But look, there is one mechanical tailwind coming. That negative drag from the U.S. federal business, the one hurting the Americas segment recently, management confirmed that finally sunsets in Q4.
Oh, okay. So that anchor drops off, and we should actually get a clean look at the real commercial baseline again.
We will. The comparisons get much easier. The underlying tension is just whether they can rotate into platforms fast enough. Because taking on long-term debt to fund $9 billion in acquisitions right now is... it's a massive gamble.
A huge gamble, but maybe a forced one. Julie Sweet was pretty intense about this on the call. She said, quote, "We cannot have an AI revolution without critical infrastructure, and you cannot have those without OT security."
Yeah, the classic picks and shovels. Except now they're realizing they have to sell the security fences before the gold rush can even continue.
Right, which perfectly justifies the buying spree. It's wild to step back and look at it. They're transforming from a traditional army of consultants into essentially an industrial software shield.
It's a sharp pivot. We just need to watch how heavily those purchase costs drag the bottom line when the next quarter prints.
Exactly. We'll see if this $9 billion lifeboat keeps them dry. Thanks for sticking with us through the weeds today, everyone.
Try not to buy any enterprise software companies on margin before we talk next.
Always solid advice. See you next time. So if you like having these episodes just automatically show up on your device, feel free to follow the podcast. We do put this together with a bit of AI assistance, which is honestly the only way we manage to process hundreds of pages of SEC filings overnight without going completely crazy. We would love to hear your thoughts or see your ticker requests, so just shoot us a note at earningsunscripted@datamadness.ca or grab the X link in the show notes. See you next time.
Have a good one.